Bob, usually when I mention your name in my videos, often people say, well, Bob is always bearish, and yet they call you a Perma Bear. I'd like to give you a chance to address your critics.
And I get this, why people say Prechter's too bearish. But if you look at that picture, you can see why I think we are in for the biggest bear market that any of us have ever experienced. And do you know that they topped out on the exact month that the Dow and the S&P topped out, January 2022. They then plunged virtually to zero.
Your point of view is, or your analysis saying that we have essentially topped in the fifth wave of the big major bull market that started over a century ago. Am I wrong, or is that correct?
You are correct. One of the descriptions of wave two is that investors relive the psychology of the previous major turn. I'm sure you've seen that charts of the S&P equal weighted index. That S&P has gone nowhere. And if you take out the 7 stocks from the S&P, it's flat on the year.
Yes. If you're right, that means we're expecting a big wave 3 crash sometime in 2024 probably, or by the end of this year. And that would mean, if that's correct, if a wave 3 crash is about to start sometime in the next few months, that's going to be devastating, obviously, right?
I think that's the wave that you definitely don't want to be along for.
Is that red arrow more or less correct as to where we are right now in the potential bear market? All right, guys, hello and welcome. Welcome to this special video with our guest, Bob Prechter, who needs no introduction. I'm sure most of you know who he is. He's by far one of the most well-known analysts out there, both in forecasting and Elliott waves. And we're going to talk about the markets, the stock market, because Bob has a very interesting forecast and prediction about the major stock markets. He talks about it in his book, Conquer the Crash, which I highly recommend and suggest you get. And I want to know what Bob Prechter thinks about the major stock markets. And where does he think the next big move for the market could be, either this year or next year in 2024? What could be the next major move for the markets in the year 2024? All right, guys, join us. All right, guys, welcome back. Bob, thank you very much for joining us. For those of you who don't know Bob Prechter, he developed a theory of social causality called socionomics. Highly suggest you get his book, The Socionomic Theory of Finance, and also is most well known for his application and enhancement of Elliott wave theory, which he discusses in his book, The Wave Principle, and of course, the Elliott wave principle. Okay, thanks very much indeed, Bob. Really appreciate it. And let me just say again, I really appreciate you joining us for this video session.
Good time.
I actually had a chat with you earlier, and you said you're in Georgia. How's the weather in Georgia treating you right now?
Oh, it's beautiful. I love the seasons here. We're in North Georgia. Central Georgia is a little bit different, hot and humid all the time. But up here, yeah, we get a full 3 months of fall, a full 3 months of spring.
Yeah, I'm looking forward to coming close to you in Florida just in a month or so for Christmas. So it should be good.
If you like a side trip, let me know. Come on up.
Yeah, thank you. I appreciate it. By the way, Bob, I hope you don't mind me asking this question because it's the elephant in the room and it usually comes up whenever I mention your name in my videos. Now, let me say again that I highly respect your work. I religiously read your newsletter, The Elliott Wave Theorist, which by the way, guys, I highly recommend. Check out the special offer we have for the Elliott Theorist, thanks to Bob. So make sure you check it out. There's a discount for you on joining his newsletter. And that's on elliottwave.com/Alessio. So Bob, usually when I mention your name in my videos, often people say, well, Bob is always bearish, and yet they call you a Perma Bear. Let me say again, this is unfair in my view, because I've seen your work and I know you've been bullish on the markets at times. So it's just simply not true that you're always bearish or you're a Perma Bear. And secondly, you're following your methodology, you're following your system. Which is the same methodology that I also apply in my work. I'd like to give you a chance to address your critics who make this unfair accusation about you.
I mean, people are welcome to say whatever they want. I really don't. I really don't care. But yeah, there have been times when I was very bullish on stocks. 1982 comes to mind. 2016 in February, the market had been correcting for a few months. I got extremely bullish at that point. But they're right in some ways. I've been too bearish for much of the, especially the last few years of the bull market, partly because sentiment indicators were showing us things that they hadn't done in their entire histories. But yeah, I just don't see any reason to get really defensive about it because again, my response is always compared to what? I mean, is there some other group of people out there that have been brilliant and
Yes,
caught every
exactly.
single move? So what people are doing, this is a false kind of approach because
Yes,
it assumes perfection as your
yes,
standard. Nobody's
absolutely.
perfect. We're all working with probabilities.
No, you're absolutely right. I get it wrong on multiple times in my analysis. You're absolutely right. Expecting the analyst to be correct every single time I agree with you, is totally ridiculous. But I think it's mostly comes from people who want certainty from analysis, and that's, I think, the wrong mindset. Would you agree with that?
I think, well,
Yeah.
yes, a lot of people want it, but we've got a great group of subscribers from young people, who might be in college, all the way up to professionals, and all the way up to money managers who hide my newsletter in their desk because they don't want people to see that they're looking at Elliott Waves too. But
Right.
yeah, I mean, look, there's so much more to the stock market than, calling every turn. I mean, I do that. That's an important part of it. But haven't you found the stock market to be just a fascinating place?
Yes.
Especially when you have a model like the Elliott Wave model, within which you can judge what's going on. I just think it's amazing to watch human behavior. And what people were doing. I'll just give you one little example. In the fifth wave of the fifth wave, which was maturing in 2021, a whole new craze took hold. And again, social mood was so positive that it drove people to invest in something called NFTs,
Yes.
non-fungible tokens. And we thought we had seen everything when they were throwing money at people in SPACs, which are companies that are going to manage your money, but they're not going to tell you what they're going to do with it. We thought that was off the chart crazy. And then the NFTs came along and they were bid up from $0 to $1 million a piece. And we wrote it up in real time and we said, this is gotta be a capstone to positive social mood as it applies to people who want to speculate on things. And do you know that they topped out on the exact month that the Dow and the S&P topped out, January 2022? They then plunged virtually to $0 and it was over. So
Yeah,
that was a manifestation of
I
social
agree.
mood. And that's a
It was.
fascinating thing. Did you call miner 4 or 5? Well, maybe not, but these are the kinds of observations that we make because we know the paradigm that the market truly is in, which is a wave of social mood.
Yes.
So we look around for supportive manias and other things that are going on. And it's just a fun place. So, subscribers sometimes stay with us, not because, we call every move, although we've made some great calls, but I'm not going to try to go over them just to be defensive, but just because we have a perspective that's just so dang fun and interesting.
As a matter of fact, let's get to your Elliott wave count on the stock market. And from your book, there is a screenshot which I want to share. That's okay with you, Bob? Let's go to that one. Just to be clear, guys, first of all, highly recommend get Bob Prechter's book. Here's a copy. I have. This is your book, Conquer the Crash. By the way, if you go to the link in the description, you can get this at a special discount. Highly recommend it. This is a screenshot from one of your chapters in your book, where you show the wave counts and you've annotated it with what central banks usually do and all that. But I want to go to this next one because, well, actually, this is from your newsletter, The Elliott Wave Theorist, which again, highly suggest check it out, subscribe to it. This is from one of your recent newsletters from October. Now, in your newsletter, you show this fascinating chart, which I have to tell you, absolutely beautiful chart and fascinating, especially for anyone who's interested in technical analysis and Elliott waves. So this goes back all the way. This is the Dow Jones Industrial Average, going back all the way to the 19th century, beginning of the 1800s, all the way to most recent times. What you're saying, I think, is that we're approaching, or we have basically all 5 waves essentially have completed, all 5 waves in the larger trend, which started back from the 19th century, a major, massive bull market. So basically, the 5th wave of the 5th wave has completed. By the way, those red numbers, I've added it myself based on another newsletter of yours. So I hope you don't mind. I've added those red numbers just to make it more simple for people who are watching this, so they can understand what you mean. So in other words, your point of view is, or your analysis saying that we are we have essentially topped in the fifth wave of the big major bull market that started over a century ago. Am I wrong, or is that correct?
You are correct. And it's not, there are several factors. Number one is the wave structure. That's number one, the form. I think it's a clear 5-wave structure. Number two, people have been following this basic idea for decades. R.N. Elliot basically labeled things that way, and he didn't even have data before 1857, but he knew there was a depression, and he said that was wave 2, and he had it mapped out through 1948 when he died. Hamilton Bolton took over, and he maintained the same wave count. Richard Russell and A.J. Frost took over. They maintained the same wave count, and I took over and maintained the same wave count. So we have been true to the model throughout the whole time. And people say, I get this, why people say Prechter's too bearish. But if you look at that picture, you can see why I think we're in for the biggest bear market that any of us have ever experienced.
I've noticed some analysts adopt this other position for the 3 and 4. How come you didn't agree with this view? The 3 and 4 being the 2007 crash, as you can see on the right-hand side. Why is that view wrong for the 3 and 4?
First thing I would say is I'm okay with it.
Okay.
I'm not going to sit here and, debate somebody over the fine points. However, you notice both of them exhibit alternation. The wave 2 is a zigzag.
Right.
Wave 4 is an expanding triangle, and the wave 4 that you could put up there is an expanded flat.
Right.
So those are perfectly okay. Mm-hmm. But I did write up several pages one time explaining why I had picked that. And it has to do also, that period in the 70s that looks rather small or benign, where your 3 to 4 are. Well, try plotting them inflation adjusted.
Okay.
That period was a lot of losses. And if you take the Dow and divide it by the PPI, you can see that was a really terrible time for stocks. Not only into the 1974 low, but also the 1982 low was much lower in real terms. So that was a very, very serious correction.
Bob, I just a few more charts on the stock market. So I think just zooming in from 2009 to 2023, which is where we're right now. So this is the final part of that wave 5 of 5. And again, this wave count I got from your newsletter as well. So essentially what you're saying is that the market has topped in the wave 5 of 5 back in 2022, January 2022, as shown at the high there. And I remember at the time you were talking about a likely top. So we're not just some people saying, oh, you only notice in hindsight. No, Bob Prechter was talking about a likely top. Back at the time, I remember you called it, Bob, by the way, well done. What I mean is you called that major top before the big decline occurred in 2022. And now, according to you, you're saying that the current wave count is that we're starting the waves 1, 2, and 3 of a downtrend of a larger degree A wave, if I'm not mistaken. So this is the larger, in magenta, I've labeled this in purple magenta. So waves 1 and 2 of a larger degree downtrend of a bigger A wave. So you're expecting this. So basically, in your view, this rally we've seen since the lows of October last year, this rally is so far a wave 2 correction to be then followed by a large wave 3 crash going into 2024, 2025, likely. Would this be correct in your view? So in other words, you don't expect a higher high or all-time highs anytime soon this year or next year.
That is the way I see things. And if you read Elliott Wave Principle, which I co-wrote with A.J. Frost way back in 1978, one of the descriptions of Wave 2 is that investors relive the psychology of the previous major turn. So if it's Wave 2 as a pullback and you're getting close to the previous bottom, people are just as afraid of the stock market as they were at the bottom, and the reverse happens at peaks. People will be just as optimistic and oriented towards speculation as they were at the actual high. And we certainly have been seeing that in the summer and fall of 2023. I mean, there are numerous indicators. Some of them have even gone to new all-time highs, showing people's desire to speculate in here. So I think it's classic Wave 2 behavior. The only sort of caveat that I would throw in is something we discussed earlier, because the wave one down in the S&P had overlap between waves 1 and 4. And when that happens, the certainty level is greatly diminished. Now, I'm calling it a leading diagonal. And so far, wave 2 has been a pretty clear ABC. Now, one other thing that I think has given me some more confidence on this count is that when you look at the broad market indexes like the Russell 2000, you'll see that there are no overlaps. It's a very clear 5-wave structure on the downside, struggling corrective rally on the upside that didn't even retrace 50%.
Interesting.
And then recently made another new low after another very clear 5 down, following every rule of the Elliott wave principle. So what's happening is people's super optimism, which is typical of wave 2, is causing them to concentrate their buying in very few stocks. As we said earlier, there's about 7 tech stocks that everybody loves. Well, unfortunately, they not only affect the NASDAQ indexes, but they're part of the S&P and part of the Dow. So these blue chip indexes have been holding up. I'm sure you've seen that charts of the S&P equal weighted index, that S&P has gone nowhere. And if you take out the 7 stocks from the S&P, it's flat on the year.
Yes.
So we talked about what B waves are like. Well, second waves, very similar characteristics. And the rally that we've enjoyed since last October, which may have ended in late July, at least I think it has, was extremely selective. So much so that if you invested in 493 S&P stocks and didn't include and put an equal amount of money in each one of them and forgot to buy the other 7, you'd be down on the year. You'd be flat on the year. I mean, that's miserable. So even though the S&P is up and everybody, look, S&P is great. Yeah, well, it's extremely selective, and that is a classic B wave or wave 2 condition. So when I look at all the evidence, that's my opinion. I've been wrong before, and maybe I'm wrong this time.
Well, I'm not sure, because what I'm saying is, if you're right, which I hope you're right, but also there's a part of me, I think everyone's probably thinking, if you're right, that means we're expecting a big wave 3 crash sometime in 2024, probably, or by the end of this year. And that would mean, if that's correct, if a wave 3 crash is about to start sometime in the next few months or the next several weeks, that's going to be devastating, obviously, right? I mean, and I assume we would know that.
Market, depends on what side of the market you're on.
Depends which side of the market. Yeah, that's right.
So, it could be one of the most profitable times to be a bear ever.
True.
But, the word crash, I think crash potential is definitely there because third waves tend to be very persistent. It doesn't necessarily have to look like, say, what happened for 2 weeks in October of 1987 or 1929 over a week in 1929. It certainly could, but it may not. It may just be a persistent decline that, every other day people can say, oh, maybe that was it. Maybe that was the end. Go look at a chart of the U.S. stock market from April 1930 to July 1932, which is about a 2-year period. It actually went up for more time than it went down. It would go down sharply and, for like 3 weeks, and then spend a month and a half going up, partial retracement, and then we go down sharply and do it again. So we'll see how wave 3 develops, if it develops. And I think that's the wave that you definitely don't want to be long for.
Right, exactly. And I assume a break of the lows we just made recently, if the stock market were to break below 4,100 on the S&P, I mean, we would know that that's likely the wave 3 taking us.
I never look for taking out lows or highs for confirmation, because sometimes it can just be the end of an ABC.
Right.
So always looking at current events to tell us, what our opinion should be. So we're holding an opinion. We're quite firm about the opinion. But I've been firm and wrong before. So, we could be wrong here, but we know why we think what we think.
I guess I have a question for you. What would make you think, if you can, maybe a brief answer to this one, what would make you say, you know what, the way things are looking, maybe we'll go towards all-time highs? I'm not saying this is what's going to happen, but what would make you change your mind and say, it's looking likely we might make another new high? Because there's going to be some people in the comments section on YouTube. We're going to say, well, Elliott waves are a bunch of hooey, and all you're going to do, this is what they're accusing us of. They're going to say, all you're going to do is if the market makes a new high, you're just going to keep extending wave 5 higher and higher like an arbitrary, like a piece of string. You're just going to keep pushing the wave 5 up and up and up arbitrarily. Now, I know this is nonsense. I don't agree with that. But what do you say to people who, well, what if the market just makes a new high?
Well, the first thing I would say was, I didn't make the market go to a new high in its fifth wave. The market just did it. So all we're doing is saying what are the best labels under the Elliott wave model.
Right, exactly.
And I really don't think that I'm going to answer that question because, for example, in 1929, do you know there were some sectors of the market that made new all-time highs in October, early October 1929? Most people don't know that.
All right.
So if one sector happens to be these 7, or probably it'll be 2 by the time it were to happen, tech stocks pushes the NASDAQ to a new high, would I freak out? No, I think I wouldn't. And then, you say, well, what if the Russell 2000 goes to a new high? I'd say, yes, good luck on that. But I mean, anything is possible.
Yes.
The market can do absolutely anything. And we would have to see at the time what we thought. Now, one possibility, if it made a new high, you might say, well, because of the internal behavior, it looks like a B. So maybe we're doing a high level flat correction for some reason that we didn't anticipate. So you can't say necessarily that it's just another fifth. It could be a B within a 4 that's part of something.
You're right. Yeah, that's absolutely right.
So, I mean, there are different options, but, why speculate? I think if people want to know what we think of the market if it makes a new high, well, let's just wait. If it makes a new high, you can come and read us.
Yes, absolutely. You're right. Yeah, because my next chart is this one, which is on one of your pages of your book. By the way, this is not a wave count of the stock market, but it's an idealized wave count of Elliott wave. It's Elliott wave theory. But assuming all 5 waves have completed of the major bull market, is that red arrow more or less correct as to where we are right now in the potential bear market? Is that
That's exactly where I think we are?
Okay. And
that is exactly right.
It's pretty scary then. So it looks like we could be heading for a multi-year. This could last potentially a decade, right? I mean,
the market could be at the next 2 where you have 2 in parentheses.
So you mean these 2?
Yeah,
correct.
We could be there, and if you look at something like the Russell 2000, it looks more like that.
Right. So you mean we could be we may have already completed wave 1 and wave 2, and we could be setting up with a wave 3 soon, sometime in 2024 or sooner, perhaps.
Yes, it was a very robust wave 2 in the Dow and S&P, but not in the broad market. So this would be a good representation of where the broad market is. Yeah.
Got it. Thank you very much, Bob. I really appreciate it. Guys, make sure you check out Bob's newsletter. Let me say again that I myself am an avid reader of Bob's newsletter, The Elliott Wave Theorist, which you can get a subscription to and also at a discount with the link you see here, elliottwave.com/Alessio. Go check it out. I'll put the link in the description. I believe you also get a discount on Bob's book as well. Highly recommend that. Check out his book and also the socionomic theory of finance. Thank you very much, Bob. Really appreciate it.
Alessio, I think you've been asking me more interesting questions than anyone has asked me for many, many years. So good for you.
Thanks very much.